as far as the papers, I'm getting really close. I have like 9 left. It's very time consuming because I'm typing you comments, which takes a lot of time. I can grade about 4 an hour, and I think I have 9 left. So I've got 2 hours left. Unfortunately, I have classes all night, but I do have an exam tonight at 7:30, which is an hour, so I can see if I'll get 3 or 4 of them graded during that. So I'm absolutely committed to getting them all done by tomorrow night. So we'll see if I can do that. Many of them are really, really good. Some of them are really struggling. A few of them are really, really struggling and that I don't really understand because they're saying stuff that's not anywhere on the graph. And so I think the biggest problem students are having is they're like, I'm committed to using all of that Walmart language. So if my company didn't have subsidiaries with special issues, Walmart did, I'm leaving it in my company. It makes no sense to me. So I think some students are so into the multiple choice class that, actually sit down and look at something and say, what is it telling me? It's just like, I can't do that. You got to learn how to do that. Boy, it's so critical to your career. So I get very positive reviews on this class. I get very negative reviews on this class. It's the only class I get serious negative reviews on because some students are like, this professor expects us to learn stuff and put it in. I'm not a finance major. Why would I care? Well, because finance is going to decide every single thing you do in your business. So you better learn it. But yeah, it's not easy, but that doesn't mean you have to get 100%. So yeah, there's stuff you might miss, but some students is like, it's hard. So I'll just make stuff up, and I don't understand that. You look at what's on the chart and talk about it. I will when we pass it back. I haven't decided yet, but I will let you fix 2, maybe 3 things that we'll see. If you get 90% on an item, fixing it probably won't make much difference, but some of you are getting a 0 on an item because you completely missed it or something, and then you can get points back on that. On the comments, probably what I'll do in the comments is, someone really strongly objects. The comments don't give grades, and they're not particularly negative. And my guess is you only care about your comments anyway. So what I'd love to be able to do, because it's so time consuming, is leave them all in Excel like I have them, but put it by your ABC 1, 2, 3. Would that be all right? Can you find your own, or is that an issue? Anybody have an issue with that? If an issue with that, let me know, and I'll have to do yours separately. But if I have to do all 40 students separately, emails, it's just, and guess how many typos there will be in your comments? It's going to be enormous, right? Because I'm typing this stuff really fast. But you should be able to figure out what I'm saying. If you can't, you can email me and talk about it. I want to get the comments to you before the exam so that you can see if you're missing something obvious. Some of you are still, networking capital is falling. That's deteriorating. It's not. Networking capital coming down is a good thing. So some of you are like, their networking capital fell, and you're like, well, I'm hoping they can get it back up to more historical levels. Well, no, you don't want them to. Lower is good. All right, so that's the one a lot of students still struggle on because it's the opposite of what your accounting class does. All right. As far as the exam, what I'd like for you to do, you don't have to, what I'd like for you to do is actually take it on your laptop so that you can type it. If you want to do it by hand, you can. I'll bring some. You probably need to let me know if you can do it by hand so I know how many to bring. So what I'm actually going to do, and the way it's going to look, just so you'll know, is I'm going to provide you a Word document with all of the graphs in it and no text. And you provide the text on a company I'm going to select for. You can have your company's Word document open, so you can refer to your company's Word document. So it's not closed book, but it is closed notes. So you can't refer to the notes, but you can refer to your company. All right, everybody understand that? So I'll email y'all or put it on Blackboard, the actual exam. You load it. Hopefully we don't have anyone doing makeup because that's going to be a pain, because then I have to create an entirely new exam, which takes some time. So hopefully everybody will be here. So you can type it and you'll submit it on Blackboard, because I will check plagiarism. If 2 students have the exact same answer, that's going to be a big issue. The reason I'm providing you the company and being picky on it is I want to make sure it's a company that doesn't have those massive issues some of your companies have, which makes it just difficult to do the analysis. All right, any questions on that? The exam's what, next week sometime? Tuesday or Thursday? I don't remember which day, you may remember. Is it Tuesday or Thursday? I think y'all's is Thursday. So, all right, so it's a chance to really, now time is an issue. So all we have is the time of this class. The professor before, I'm gonna try to catch him and see, he kind of dawdles afterwards, kind of taking his time. I was like, can you go? Can you go? And the class after this, we could probably start as early as 2:25 and then as late as 3:55 without the other class. But you're not, once the time runs out, you're done, right? So why is time an issue? Well, because if you know it, time's not an issue. If you don't know it, time becomes a huge issue. So you can't come into this and say it's open book, so I don't need to study. You got to sit down and learn the material, right? You got to know it very quickly. All right, so it's stressful. Yeah, college should be a little stressful. You're not learning anything. So, all right, no questions on that. Rate's good. So what I want to do today is get through the notes on capital budgeting, and then I'm going to do an actual capital budgeting, which is actually one of your financial application homeworks. But you can watch me do this and observe and not have to type so fast, because this will also be on a video for you to do that homework. So you're going to have it. So don't feel, and plus you got the YouTube for the class. I actually think it's the best way to learn capital budgeting is to just actually sit down and do one. I have a real life case. This one I actually did at UTSA, so we'll do a real life case. So let's finish up the notes. So this is one of the most traditional decision-making analysis. It's a very common question on interviews to actually do this type of cost-benefit analysis. You can call it cost-benefit analysis. You can call it capital budgeting. I remember at UTSA, I was on a team from all over the company, and the project was capital management. And the name of my department was capital management. So I thought, well, great, we're going to talk about my department. And there was this huge fight between the finance and accounting people on the definition. And we never resolved that. The senior officer in the group, he at the very end said, I'm glad y'all spent all this time on the group, but I've already decided what we're going to do. I was just curious what y'all are going to come up with. And since they just wasted your time for 3 months, that was really encouraging. But we could not decide what the word capital meant. The accountants heard the word capital and they were thinking assets, like capital assets, like buildings and machines. Finance says the word capital, and we're thinking the other side of the balance sheet. It's debt, it's equity. I think that's the correct definition. I think the accountants get confused because they hear capital assets and they think, it's an asset. But what we mean by capital assets, it's an asset you buy by borrowing money or using retained earnings. So it's an asset you buy using capital. The capital is the liability and net worth side of the balance sheet, all right? I'm pretty sure that's the right answer, but we could not ever decide on that. So by capital budgeting, what we mean is we're taking the resources of the firm, its debt, its retained earnings, and we're using that to invest in projects. So it's a capital budgeting process of how we're going to use the money of this firm to improve the firm. It's probably the most important decision management makes. They're deciding how to spend money to improve the firm versus giving the money back to their stockholders or paying down debt. Pretty critical decision. If they get that wrong, the company is not going to survive. So the primary function here is, our question here is, will doing this project improve the value of the firm? Projects that increase the value of the firm should be done. Projects that don't increase the value of the firm should be avoided. All right. And as we talked before, this is what your project has to look like. We talked last class. Did any team decide on their project yet? I haven't seen any emails yet. Or has anyone got it down to 1 or 2? Kind of iffy. So y'all, your team. All right. So we're getting close. I don't want 2 teams doing the same project. So if your team says, hey, we're going to do a cat sanctuary as our project, then let me know, because other team might want to do that. So as soon as you decide, let me know. But we're doing projects. Not all capital projects look like this, but I want yours to look like this. You have an initial house outlay. You're going to buy something. You're going to invest in something. And then every cash flow after that is a benefit. It's a positive cash flow. I don't want you to have a project where there's an initial investment and then there's benefits, and at the end there's a big cash outflow again. All right. If you build a nuclear power plant, I don't know if any are doing that as your project, but a nuclear power plant, you spend $1 billion up front. You sell the energy for 50 years and at the end you have to decommission it. That's going to cost you billions of dollars. I don't want you doing that kind of project. I don't want the sign to change more than once. So you start off with negative cash flow, then it's all positive cash flows. All right, very, very important. Here's the tools we're going to use. Y'all probably have done some of these before, haven't you? Net present value. Have y'all done net present value before? We'll walk through it. You might hear profitability index. We're not going to use it in this class. What it's used, we'll talk about it, but we're not going to use it for your project. And the reason we're not going to use it for your project is it's a statistic that helps you pick between 3 or 4 or 5 projects, but you're only looking at one project, so you don't really need it. We will do discounted payback. Many firms use payback. We're going to use discounted payback, and I'll show you how to do that. It's probably the hardest part of setting it up. And then internal rate of return. And there are other approaches that we're not going to use, terminal value approaches. We'll talk about why these are often discussed because there are problems that we're going to run into when we look at these type of projects. But the ones you're going to do in your project are net present value, discounted payback, and internal rate of return, those 3. And of those, Bill Gates is going to do most of the work on the net present value and IRR. The only one you have to do a lot of work on is the discounted payback, and I'll show you how to do that. It's the hardest part of the Excel. And so what you have to do with your project is essentially forecasting what are those incremental cash flows that doing this project will create. We talked about it before. So if you're doing a franchise, I think a few of y'all are thinking about a franchise. So times 0, you have the franchise fee and some capital. Bill Gates, I don't know why. Thinks I ever want the cap locks. So you pay the franchise fee. That may be $100,000, $200,000. They may require you to buy a building, but usually you're going to lease, so that won't be an upfront cost. That'll be over time. You might have, you buy a Subway, you might have to buy some ovens, you might have to buy a cash register, who knows what. There might be some marketing upfront that you got to do. There may be some training, but upfront. And then what do you have? Then it's just net revenues minus costs, and you just forecast the business out. Pretty straightforward. Where do you get all that information? Well, Subway will give that to you. The franchise, if it's a good franchise, the franchise will provide all of the information online. Very easy to find, not difficult at all. If you're doing solar panels, what do you do at time 0? I can think of at least 3 things. What do you do at time 0? Installation. Okay, installation, yeah, that's going to cost you some money, right? You got the panels themselves. Maybe you have some kind of tax rebate. Maybe that's going to reduce the cost up front. I was going to do solar panels for an organization I work with, and one of my former students was in this business. He sent it to me. I go, wait, where's the tax rebate? Oh, City of San Antonio cut that from $100,000 to like $3,000. I said, yeah, that's kind of material to my analysis. I was kind of relying on that. That's a pretty hefty drop. So the tax rebate, I don't know what President Biden's going to do for solar panels, and if he's going to put any kind of tax credit in there to make that more available, but that's important. And then what are your ongoing? So your ongoing, you're going to save utility bill. Pretty straightforward, right? How do you get this information? There's a million websites. And what are those websites? Are they giving you unbiased information? You find a website that sells solar panels. Is that a reliable source, do you think? San Antonio has on average, what, 383 sunny days a year? Doesn't sound like a good assumption. So they have an incentive to exaggerate their numbers. How do you figure that out? Or if I were doing a solar panel, where I'm riding my bike, there's a guy with solar panels. I might go to his house and say, hey, what's the real numbers? What have you really saved? Give me some background. I might go on Facebook and say, hey, I got this project at school. We're doing it on solar panels. Any of y'all have solar panels, you'd be willing to do a survey for me, or anything like that. Try to get real life information, because your source, same thing with the franchise. Your source, if a franchise trying to get you to invest in their franchise, is a good chance their data is biased, exaggerated. How do you figure that out? That's when you go to YouTube and you type that franchise in, and you start seeing all these franchise owners telling you the real scoop. And you say, well, they say you're going to get this kind of money, but you're not going to get that kind of money. Or you're going to have 2 workers. I tell you what, you're going to have to hire 3 workers. There's no way you can get it to work. There's plenty of places to test those assumptions. I'll talk about an example project, how we do that. But that's what you're looking for, an upfront cost, and then you got to forecast those cash flows. And it's always incremental cash flows. Nice thing about our project is we're going to ignore taxes, which makes it a lot easier, because taxes can get pretty messy. So that saves you a lot. And then the second thing you would do is talk about the discount rate. Well, unfortunately for this class, we talk about discount rates too late in the semester for you to put that in your project. I guess it's almost fortunate for you. So for us, just pick a number. In fact, 5% is a decent number to pick. So if you want to just pick a number like 5%, that's fine. In reality, if you're working for a firm, they will have an official discount rate that you go use. At USAA, you can go over to Laura Bishop's department and find another guy whose last name is Bishop, and get USAA's discount rate from him. You be on a spreadsheet, you just call them up and say, hey, it's 3.7%. You just use that number. For our purposes, we'll just say it's 5%, just so you have a number. Very important number, because if it's 7% or 3%, that's kind of it's going to become really important. If you're doing an electronic vehicle, how long can you assume that'll last? 7 years, maybe 9. It'll last longer than a gas car, but are you going to assume it lasts 25 years? Probably not, unless you live in Costa Rica, where we are, where I do my charity. Boy, they keep those cars for it's amazing how long they last. But you gotta make some assumption about how far in the future you go. The further in the future you go, the more important the discount rate goes. But we're gonna ignore that. We're just gonna use 5%. So this is where your focus is gonna be on the project. And you do want to think of everything. I say ignore taxes, but I'm talking about income tax. All other taxes like sales tax, property tax, tax rebates, those you do want to include, all right? So when I say exclude taxes, I just mean income tax, because that's where it gets really, really, really messy. And I do mean think of everything. In fact, what we're going to do here is we're going to have kind of work points where I'm going to meet with your team. And that's where I'm going to try to help you out, is like, did you think of this? Did you think of that? What about that? How did you get that number? To try to help your team progress, so you don't get stuck in kind of, some teams just kind of lose their footing. So I'll help push you along on that. So we'll work some examples, but what I actually want to do is the example I want to use. I want to start with an actual real life example. So before we talk the rest of the class notes, I want to actually do a cost benefit so you can see exactly how it works. So how many of y'all have done net present value before? Just raise your hand. A couple of y'all. Was it an accounting class? Yeah. Like a management accounting class? And the rest of y'all have never done one? It's been a while. You've done one, but it's been a while. All right, so let's do one. Let me show you the problem. This is an actual problem that came to my desk. So it's a real life decision. I'm going to teach you how to set it up, and I'm actually quite picky on this. The Excel spreadsheet that you submit with your project is a big part of the grade and how you set it up. So I'm going to show you what I consider to be a good Excel spreadsheet, and you can jump in and add your ideas as well. So your boss has asked you to do this cost benefit analysis. It's a cash management automation project. Cash management is it's not how they manage their cash, it's really how they process things like checks. And this is really processing checks. So USA has a property and casualty business, a life insurance business, a investment business, and people mail checks to USA, still mail checks. And USA has to accept those checks, open them up, endorse them, put them through the system, get them into the person's account, send them to the bank. The bank's got to deposit it. All right. So when I was there, boy, it was getting pretty automated. They had a machine that could do 40,000 checks an hour. And I mean, this was years ago. So today, I mean, it's probably 80,000 an hour, who knows what. But the machine would take the check and the invoice out of the envelope, endorse it, look at the handwritten on the check and see if that matched the invoice. If it did, it went through the bank and no one ever touched it. 40,000 an hour, that's pretty fast, all right? But that's not what this project is. This is the exception project, all right? So what USA discovered is many of the customers went to their bank and their bank had bill pay. Have y'all heard of bill pay? Y'all probably use bill pay. Use your bank to pay your bills. And so what people said is, you know what? I don't want to mail USA a check with the invoice. I just want my bank to do it. So I'm going to do it through a bank. And so your bank says, well, what's your account number? What's the address for USA? And we'll mail the check. You feel like it's all electronic because you're doing it through your bank, but it's not. Your bank actually prints out, or did back at this time, prints out a paper check and mails that to USA. So can you imagine what just happened? Remember the machine that did 40,000 an hour? What does that machine do now? You can't do it anymore. It doesn't have the invoice. It's not a USA envelope, right? When the machine saw the envelope, it was USA envelopes. Now it's somebody else's envelope. So what they had to do when these envelopes showed up is they had a small department. It was usually 3 people that would take these envelopes, manually open them, look at the check, look at the invoice, try to figure out where it belonged, input it into the system manually. Do you think they were doing 40,000 an hour? They were barely doing 40,000 a year. I mean, it was really slow. I remember I went and watched this department because I wanted to understand this. And I was watching the lady, she picks it up and says, or this check is addressed for PNC auto insurance, but it doesn't belong to PNC, it belongs to a life insurance company. I said, well, how do you know that? Well, because it's wrong like that every month. So, okay, that's interesting. But can you imagine someone mails in a check for life insurance, but they put it to the wrong address, it goes to the property and casualty. Property and casualty, they process it as a property and casualty for auto insurance. It should have been life insurance, and during that time, the person that's insured dies, and now you say, well, you didn't pay your life insurance bill. They say, yeah, I did. And they're like, well, no, but you double paid your auto insurance. But it was pretty frustrating, right? People are upset. You got a department of 3 people handling fewer checks than our machine can do. You know, there are fewer checks in a year than our machine can do in an hour. The customer is upset. I actually called some of the USA customers and got their feedback. I said, yeah, there's all these errors that y'all never get it right. And so people are really frustrated. So we went to the biggest bill paying service that was sending these to us. There was a bunch of banks, but we went to the largest one. And we said, is there some way, instead of you mailing us checks, could you instead send us an electronic file and we do this whole thing electronically? That'd be kind of nice, wouldn't it? So instead of the bank producing a check and mailing it to us, they'll just send us an electronic file. So that was the project. Everybody see that? Does that sound like it'd be valuable? Any intangibles there? You as a customer, you'd be pretty happy, right, that your account got credited correctly. What about the 3 people in the department? They may be losing their jobs. That might be a negative intangible. It's a positive because you're going to save money on their jobs. Could be negative. And I always felt bad about that. As I'm in a project where these 3 people are going to lose their job. As I talked to them, they're like, yeah, please end this job. Because they knew if I destroyed that job, they knew Carol would just put them over in the other department with the fast machines, which they much preferred anyway. So they're actually begging me, yes, please destroy this job. They hated that job. You would too, wouldn't you? Doesn't that sound like a horrible job? You're opening envelopes all day long. There's always mistakes. People are yelling at you. I mean, it's just not a good job. So that to me was not that bad of an intangible. The biggest intangible was eliminating the errors to the customer's account. That was pretty important to us. So the paper documents we were getting were just wrong. The invoices the bank was creating didn't have our MICR line in it, so we could recognize it, put it in the right account. It was just very frustrating, a lot more errors. So they hire all these extra people to go manually through the checks. Very inefficient process, high error rate. Error rate on the automated machines with the 40,000, I forget what they were. She had to go out so many decimal places. I can't remember if the error rate was like 0.0001% or 0.00001%, but almost no errors. It was just an incredibly high quality process. Y'all don't write checks though, do you? Anyone of y'all write checks anymore? A lot of customers think, hey, if I write the check, that's what they're going to take out of my account. But that's not what banks take out of your account. Your banks take out of your account whatever the person got the check encoded on the check. So if you wrote a check for $100, but they accidentally type 1,000, they're taking $1,000 out of your account. You can say it was a mistake and they take the wrong amount out and they try to fix it. But if someone accidentally miskeyed 1,000, they're taking $1,000 out of your account. So it's nice to have a computer program that their error rate is incredibly small. And my guess is that error rate was probably someone wrote a 7 when they meant a 2, and it was just hard to read. It's probably, just interpretation kind of thing. So the cash management department came to me and said, can you get this project approved? And said, give me the numbers. This service had done this before with other of their clients, so they knew it could work. So that was kind of good. We weren't the first person out doing this. And what we thought we could do is convert a lot of the payments pretty quickly. We weren't really sure, maybe for 50% with no problems, maybe 90%. That was one of our big unknowns. So how much can we actually convert? We're pretty confident, we'll talk about that. We're pretty confident we could get at least half of them converted, which means we're going to still have the department of 1 or 2 people, but it won't be quite as much work as before. But the exact number of payments to be converted was not known. So that's part of your project, is you need to find some unknown that you're going to do analysis of. All right. So here's the assumptions. Let's bring these assumptions into Excel. Someone show me how to do snip without having to type snip, but I can't remember how to do that. There's a button you can do. Y'all probably know that. All right, I'm going to put that over here. Can y'all read that? Oh, y'all can't. No, sorry. What about there? Better? Eye test. All right. So let me show you how you're going to set up your Excel. All right. So I'm saying this because I'm picky, but I'm also saying this because I think this would have a huge impact on your careers. So when you set up an Excel spreadsheet for an analysis, you need to set it up so that someone who's not working on the project can load it and know exactly what you're doing. You want to document as you go. And you want to do that as a habit. I had some projects at UTSA where they called me and they say, hey, Ron, can you do this analysis? And I did it. I sent it to them thinking, okay, that's done. And then 6 months later, they call and say, hey, can you update that? It's like, update what? I can't even find the file. I'll find it. I'll load it. I can't remember what I did. I have to start up from scratch. So you don't want to do that with Excel. Take an extra 5 or 10 minutes in documents. So you want your first page to be an overview of the project. You want to do this with your project. You want to have a description that defines what we're trying to do. Assess if feasible and beneficial, convert paper bill to electronic, something like that. And you want that description to be very precise. We talked about an EV versus a gas car. Remember on that, the description's not, we're trying to figure out if it makes sense to buy an EV. And we're not trying to figure out, is an EV better than a gas car? We're trying to figure out if the extra cost of the EV over a gas car it can be paid for by the savings of gasoline. We're talking about the extra cost of the EV. You want to set it up very precisely. Sometimes it's pretty straightforward. If you're trying to assess whether you want to do a subway franchise, we're assessing whether or not it makes financial sense to open up a subway franchise. So you don't have to be overly, sometimes it's pretty obvious, but be precise so that whoever opens this up knows what you're doing. And then what I like to have is the different pages. So what pages would you have? We're going to have one page, which is assumptions, which is probably the most important part of your entire project. If you get the assumptions wrong, guess what we can say about your analysis? It's pretty useless, right? Bad assumptions means bad analysis. In fact, bad assumptions with a really sophisticated Excel spreadsheet is like the worst. Because the spreadsheet's so sophisticated, people say it must be right. Because look at all these fancy formulas. But if all the inputs are wrong, you're encouraging people to make a decision they shouldn't be making. You're causing havoc. You're going to have a base case, a best case, a worst case, and a break-even case. So you have to have 4 cases. That break-even is important. If you can't figure out how to do a break-even for your project, you probably need to pick another project. And then you probably want a summary. The summary probably belongs up top, I would think, but you're going to build it last. So you probably want a summary. We'll talk, and you do want for your project, you do want a summary. And I'll show you what the summary is. So the first page is assumptions. Now, the assumptions page may have other sheets to support the assumptions page. And I'll talk a little bit about that as we build the assumptions page. Now, something else I really, really like is hyperlinking. So let's set up our assumptions page. Now you might think, well, hyperlinking is, it's kind of overkill. I don't think it is. I have a spreadsheet I do for our charity. I don't know how many sheets it is now. It's got to be a few hundred. And if I didn't have hyperlink, boy, it would just take me forever to get around that spreadsheet. So, so I encourage you to at least think about it. So hyperlink is very straightforward. You just right-click on the cell, and you do link. And you want to link in this document. You want to link it to assumptions. And you can say which cell, and sometimes it may make a difference which cell you want to be on. So place in this document, I want it to go to the assumptions page. Say, okay, so now when you click on that, it takes you to the assumptions page. All right. And if you want to here have a link back to the overview, you can certainly do that. That way you can jump back and forth. So I do that a lot in my spreadsheets, especially like if it's on page 75, I can just click on it really quickly and get to it, find my data. You remember the file I created for you with all the companies? I could have created index at the front and hyperlinked all of that. It would have taken me several hours, so I didn't, but I could have done that, and then you could have just clicked on your company and gotten right to it. Do y'all use hyperlinks very often? Not at all. So it's pretty valuable, I think. All right. We're going to wait on the other ones because what you're going to do with your project, and this is really, I think, really critical for your success, is we're going to meet on your assumptions. We'll all, your team and me together, decide, yeah, I think you got all your assumptions. You're then going to build your base case, and you'll probably email me your base case so I can look through it as kind of your double check, an extra set of eyes. And once we agree, okay, the assumptions look good, the base case looks good, that's when you can build the rest of it. You don't want to build the best case and worst case until you're sure the base case is correct. All right, because once you get the base case built, you can build the best case, worst case, and break even in under 10 minutes. It's a piece of cake. It's really fast. But you don't want to do that until you get the base case built. All right. So we're going to hyperlink each one of these as we build them. So let's go to the assumptions page. So on the assumptions page, we're going to have several things here. The first thing we have is how many transactions per year. Now there's a few ways we can do this. We can go across or we can go down. I'm going to go across, but think about this carefully. You know, how you set up your spreadsheet can get pretty tricky. So I'm going to do base case, best case, and worst case there. But you might do base, best, worst there. It kind of depends. If I only have one thing I'm going to run scenarios on, it might work better to go down the page. If there's 3 or 4 items I'm going to do scenarios on, it's probably better to go across the page. But you can decide. I don't have any preference either way. Just think about it. And then the last thing you want to talk about is your source. Your source could be a website. So let's say you're doing EV vehicles, and one of your assumptions is the cost of the EV vehicle. You have a link to Toyota.com or something. All right, so your source. It can be words, but it needs to be a source. You want something so if someone clicks on your file, they know exactly where you got your numbers from. The source could also be, and we're not going to do this, but the source could also be, you got a bunch of CPI data on gas prices. You went back and got gas price inflation the last 50 years, and you just have it listed here. And maybe you have the average, the 10%, the 90%. So if gas prices really, really take off, what's that going to do to your EV analysis? Is that going to help it or hurt it? The gas price go up, not down. Yeah, gas prices go up, EV vehicles are going to look more favorable.
Brian said he cannot see your screen on the Zoom.
Okay, sorry, thanks. I thought I shared, but yeah, I'm glad you. I don't know why it won't let me. All right, thanks. So we have this. All right, so we don't have what happened last week. That's good, thank you. All right, so we got the overview page. We hyperlinked by hyperlinked by linking. We have the assumptions page, assumption based, best, worst, and source. And you could have another page on CPI. So have all this information. Maybe the average CPI for gas prices, maybe that was 2.5%. Maybe the 10% was minus 0.2%. Maybe the 90% was 4.6%, something like that. And you have all that data. You know, you may have 50 rows of data for 50 years of gasoline. And this might be gas assumption backup. And then on your assumptions page, you just have gas assumption backup, and you would just link that right to that page. And then you can pull your data. Your base case is the average. Your best case is the high gasoline prices, right? Because the higher the gasoline prices, the better the EV looks. The worst case is gas prices actually fall. And in your source can be another sheet within your spreadsheet. Wouldn't that be better than having all that data here off to the right somewhere? Kind of messy. It'd be better to have a sheet that just does that. All right. We're not going to do that because we don't have that, but you could definitely do that. Say our base case assumption is 2.5%. Our best case is 4.6%. And our worst case, just based on history, and you define it. That's how we got our scenarios. We look back at history and see. All right. We don't need that because that's not what we're doing here. But definitely do that. All right. So total number of bill paying transactions received in a year. That's 80,000. And the source for that is cash management. They just come and tell us that. That's pretty straightforward. Here's what gets a little tricky is my base, best, and worst only have one assumption. You could put it in there all the way across, or what I'm going to do is if I don't have a best and worst case, I'm just going to show the base so I know I use for each one. But either's fine. You can just show it there, or you can put it across. Either's fine with me. My assumption is if it's only in the base, then that means it applies to all three cases. That way, the only place where I'm doing the scenarios, I can see it and it highlights there in the box. All right. Transactions per employee. How many transactions can each employee do per year? 20,000. How many employees are in this department, do you think? Any guesses? 4 employees, all right, so that makes sense. I'm not running any scenarios on that. Why? Because we're pretty confident with that number. I go to Carol. Carol runs this department. She says, yeah, well, some might be 19,000, some might be 21,000, but 20,000 on average, that's a pretty, they've been doing this for years. They know what they're doing. 20,000 is a good assumption. Growth in transactions. Oh, I got to give, that came from Carol as well. Growth in transactions, where we thought, you know, a lot of people are converting to bill pay. Our growth at USA overall is about 2%, but more and more people are using bill pay. So we're going to assume 4% growth here. Now, where do we get that? That might have come from cash management. It might have come from CFO. You know, someone says assume 4% growth in this. We don't want to use the growth at USA overall because if more people are converting to bill pay, that's going to be a higher number. That means this 80,000 will not be 80,000 next year, will it? It's going to be something higher, and then it's going to be something higher. So as more and more people convert to bill pay, the more and more more people are going to. At some point, we're probably going to have to hire another full person. So is the transaction per employee going to grow? Probably not, right? I mean, it's possible they'll get more efficient, but unlikely. I saw the people there that's like, they've been doing that for years. They could do it like a million times faster than I could. They probably would have been pretty irritated if I tried to do what they're doing. They're much faster, but yeah, they probably aren't going to get much faster than that. And then we're going to say percentage of transactions converted to electric. So I'm just going to say converted. So how many transactions? Here's our big unknown. This is what we're not really sure about. Our base case is 70%. Base is median of survey. So we went out and did a survey. So exactly what I did is I went to this company. I said, okay, you've done this project with a few other companies. Can you send me some contacts I can talk to? So they sent me several companies. I called those companies and asked them, how many did you convert? Some said 80%, some said 85%, some said 40% or 50%, some said 60%. But the average of all that survey was 70. So, okay, the average company was 70. We'll probably do better than the average, but we'll stick with 70. So that was 70%. The best was what the companies, the bill payer said. So the bill payer says, hey, you know what? We can convert 90. Now, why are they telling us that? Because they really wanted us to do this project because it saved them a lot of money. So they had a bias for us to do it, and someone has a bias for us to do it. I don't really trust that. It's like when I bought my Toyota Prius, and the windows said you can get 60 miles per gallon. Guess how many times I've gotten 60 miles a gallon? Maybe if I was on top of a mountain and gliding down, but I didn't get. I got 45, maybe 50. I was lucky. I never got 60 in any such thing. But why would Toyota lie to me? Because they want me to buy their car. right? So if you do an EV and the EV tells you, your range is 300 miles, 400 miles, and they want you to buy the car, that might be your base case scenario. What's the chance that that's an average, a median number? It's probably up on the upper end, okay? And then my worst case, 50% was the lowest survey. And you can actually do this in your project. If you need a best and worst case, you can actually go out on Facebook or wherever, go find your grandparents that still use Facebook and say, hey, I want to do a survey for this project. I want to know how many people do this or that. And you have to find the team that did this last year, they actually went out and did a survey on the pharmaceuticals. How many people would use a kiosk at an HEB instead of standing in line? And they went out and quizzed on Facebook, and they, based on that survey, that's how they got their best, worst, and base case scenarios. All right. So you can see here, percentage to be converted, 90 is my best case, 70 is my base, and 50 is my worst case. And I got that by looking at the surveys that I got. So I had some basis. This may influence what project you pick. You have to do sensitivity analysis, and you have to have a basis for those ranges. You can't just make up numbers. Some basis, and I can help you with that if you're not sure, but I just showed you on EV cars, on gasoline. You can just look at historical gasoline inflation to give you some sense. History can be a good source. So if you look at history, you can break the history up between the mean, the 90%, the 10 percentile. That can give you a pretty good sense of what's going on. One thing you cannot use is your base, best, and worst is the upfront cost. So, hey, I want to buy this EV, but I don't know if it's going to be 30,000 or 32,000 or 35. That's not, because let's say you assume it costs 30,000 and then you go to the store and it's 40,000. What are you going to do? You can go back and update your analysis. Right? You're not going to pay the 40,000. So that's the type of scenario where it doesn't make sense to put that because you'll know up front, and you can stop everything and not do the project if that's the case. All right. The next thing we have is how much we're paying these workers. We've got 4 workers here. So what's their base salary? And these are kind of old numbers, but 50,000. Would you work for a job 50,000 a year to do that? You'd be pretty bored, wouldn't you, after about a month or so? It's a pretty tedious job, but 50,000. That comes from payroll. The payroll people, bunch of accountants mostly, and so people you have good access to get that information. But you also have employee benefits. Employee benefits are soon to be 15% of pay. Where do you think we got that number? Payroll, maybe CFO, but probably from payroll, but could have been from the chief financial officer. It kind of depends on what the numbers are. What are employee benefits? Your 401k plan. At USAA, they match up to what, 8%? So there's 8% right there. Pension plan, which you probably won't have. A bonus, USA's bonus is maybe 10%. So you have that in there. I could run scenarios on that because I don't know how much the bonus is going to be, but I decided not to here. But that's one number there. And then you have indirect employee costs. And there, that's $500. And that comes from CFO. What happens to this $500 if we eliminate these workers? This is things like air conditioning, desk, rent. What happens to this $500? So you eliminate 4 workers. Does that $500 go away? Stays there. Why am I putting it here? Let me show you why I'm putting this in here. I'm going to say not used in analysis. All right. Why in the world would I do that? Well, 6 months from now, when someone comes back and says, hey, let me see your analysis, and they say, did you include indirect costs or not? Do you know the answer to that? Yeah, we assumed $500, but we didn't use any analysis because that cost doesn't go away. So they might come in and say, hey, you know what, I think you included indirect costs and that made your project look better, but we're not going to save that cost. You bring up your spreadsheet. No, we didn't use indirect costs. So I'm putting something in here that I'm not even using, but I'm putting it in here so I document that I did not put it in my project. The next thing is these workers, we're going to pay them $50,000, but will we be paying them $50,000 in 4 years? Hopefully not. You hope they're getting some raises, right? So we got to put that assumption in there. So payroll inflation, we're going to assume that's 5%. That's going to come from CFO. There's a budgeting department. I used to do those type of forecasts, and yeah, every year we say assume this raise. This is the average raise for employees for all of USA. So okay, 5%, that makes sense. And then you have the software development, and we're given a budget of $565,000. That's the shakiest number in this whole thing, but I'm going to go with it. Where do we get that? We got that from IT. I could have all kinds of problems with what's in that 565. Does it include the programmer's time? That makes some sense. But does it include the programmer's manager's time? Does it include the head of the department? Does it include the president of this department? If this includes 2% of the CEO of IT's salary, do you think if you didn't do this project, you would pay that person 2% less? Probably not. So there is definitely some cost in that 565 that's really not part of this project. It's allocated, but I'm not going to mess with it because IT is so complicated. I'm gonna live with it. All right. More than likely, the true cost is less than that. So in that case, if this project is beneficial, then it's probably even more beneficial. The only time I have to worry about that 565 is if this project just barely doesn't make the cut. And then I might go back and say, there's probably $40,000, $50,000 in that 565. That's really not a cost of this project. It's costs that are being allocated to it. All right. So I kind of accept that. That's the number they gave me. So I'm just going to use it. All right. And then our cost of capital. What are you going to use for your project? 5%. This project, I don't know why I put 7 here because USA's cost of capital is much lower than that, but I use 7. All right, this is one layout. The other layout I could have done is I could have eliminated these columns, these 2 columns, and I could have put the base, best, and worst here. All right, either is fine. One thing I like about this is it's real obvious what I'm running a scenario on. So I kind of like this approach. Leave it blank if it's not a scenario, only show it when there's a scenario. Now, some of y'all might have 2 things you want to run an analysis on. All right, let me give you an example of that. Let's say you're going to buy a house and rent it out. And one thing you want to know is your vacancy rate. And the other thing you want to know is your resale value in 5 years. And your base case for vacancy rate is, say, maybe 5%. 5% of the time, you're not going to have a tenant. Your best case is 0%, and your worst case is, say, 20%. All right, so base case, yeah, every once in a while I'm gonna have a tenant leave. It's gonna take me a few weeks to get it released. So that's about over the next 5 years, that's about 5% of the time. Well, the assumption I'm gonna make is, let's say we think the property value is gonna grow 3% a year. What would you assume property values would be if there's no vacancies? Is that good real estate market or is that a bad real estate market? That's a good real estate market. So I'm going to say, hey, vacancies are low. I'm going to assume 5% appreciation. What if vacancies are really high? People aren't renting from you because they can find something cheaper somewhere else. What does that tell you about real estate prices? Probably not doing too well, right? So in that case, so if you have multiple scenarios, try to line them up, because if you don't line them up, then you got a 5% vacancy rate with a 3, 5, and 10. There's 3 scenarios. You got a 0 vacancy rate with 3, 5, and 10. That's 6 scenarios. 20% vacancy with 3, 5, and 10. Now you have 9 simulations, not 3. But if you line them up, if vacancy is 5%, appreciation is 3%. If vacancies is 0%, then appreciation is 5. And I can show you some tricks. Some of your teams, last semester with my graduate students, we had one team where we actually built a pretty sophisticated VLOOKUP table so that they could run their analysis, especially on the break even, and find, it was tied vacancy rates and resale values, so they can find their break even. And so I can help you set up something like that. But you can run more than one case. You got to be careful though that when you run more than one case, it's multiplicative unless these are related. So here I'm saying they're related. There's a relationship between vacancy rates and resale value. That way I don't have 9 scenarios, I only have 3. But if they're not related, like if this is gas prices and this is miles driven, those probably aren't related. Maybe they're a little bit, but they're probably not related. Then you're going to end up with 9 simulations. And that's kind of a pain to have that many simulations. All right, so you do need to think through that. This might also influence which project you pick. But you get all this built. And once you have it built, you're ready to start building your base case. This is a huge part of your project. All right, you've got to get this going. That's why you need to pick your project so you can start getting these assumptions. You pick your project and you list out the assumptions you need, and you break it up with the team members so they can go out and do some research. If you're doing EVs versus gas cars, someone needs to go out there and look at the typical price of an EV versus the typical price of a gas car and start getting those lined up. You want to look at gas. Someone's going to do research on gasoline prices. Someone's going to do research on typical miles driven, which there's a lot of research out there, or they're going to set up the scenario. You want to break up the work so each team member has something to do. This is a big part of the project. Actually, once you get your assumptions page built, the rest of this project is actually pretty straightforward, pretty simple, but you got to get the assumptions built. So let's do the base case. So I'm going to link it back to the overview. And in the overview, I'm going to link it base case. All right, so we might be able to get the base case. We got 15 minutes. Can we build a base case in 15 minutes? So on a scale of 1 to 10 on Excel, how many 10s are in the room? How many Excel aces do we have? How many 5s are in the room? A few 5s, any 1s? All right. You might say, I'm a marketing major, I don't need Excel. If you're a marketing major, you need Excel. If you're a management major, you need Excel. I don't know about cybersecurity. Not sure about those guys. They might use Excel. They probably do some. But every degree other than maybe cybersecurity, you're going to be sitting using Excel most of the day. You may be using Python and SQL or some other things in addition to it, but you'll definitely be using Excel. So you got to learn Excel. And a lot of interviews now have Excel quizzes. We have an Excel class this semester with Investment Society where he's going through the most typical things asked in an interview related to Excel. VLOOKUP, pivot tables, there's some obvious ones. The logic functions are pretty obvious ones. We're going to use a few of them in here. We won't use VLOOKUP or pivot tables, but we'll use a few of those in here. All right, so when you're building something like this, essentially what you're going to have is time, benefits, and costs, your net cash flow. That's essentially the way it's going to look. You're going to start off with time, then you use benefits and costs. Your benefits might be one column or might be 20 columns. Your costs might be one column or might be 20 columns. All right. So here's what I'm going to recommend you do on the time. This is, some students really struggle with this. So pay attention here, and you also see it in the video. We're going to actually use actual dates. So we're going to start with today. So just you type equal today, open close parentheses. And that will give you today, which means every time you load this spreadsheet, it's going to change that. But that's okay. So what's our only thing that's going to happen today out of all of this? What happens exactly today? That 565 is what we're going to see. I realize it's going to take them weeks or so. We're going to assume we're going to do it all today at one time. IT, I know it's not possible. IT is going to come in. They're going to program it all in the same day and go home. We're going to pay them $565,000. So there are times where your time zero might be actually 6 months, 3 months, but it's close enough to today. We're just going to lump it all in today. All right. So that's our time zero. Then we got time one. Now don't do this, but time one, we could say, let's add 365 to that. But if we do that, that assumes everything that happens in year one happens all exactly in 1 year. So what's going to happen throughout the year? Well, if we reduce these transactions, we won't need these employees. So we're going to save employee time. When are we going to save that employee time? Is that at the very end of the year or throughout the year? Throughout the year. So if we assume this, we're assuming we pay them once a year at the end of the year. I know we don't do that. But since we pay them throughout the year, do we have to like set up every single day of the year? That would be a pain. Or they get paid every 2 weeks. Do we do that? Well, no, what we're going to do is a real simple assumption, which is called the mid-year convention. And what we do at the mid-year convention is say, hey, if we're talking about a cash flow that's even throughout the year, let's just assume we pay it all right in the middle of the year. This is a simplifying assumption. Does that seem reasonable? We're going to pay some in January, some in February, some in March. Let's just assume we pay them all right in the middle of the year. When is the middle of the year? Maybe 183 days, right? What's 365 divided by 2? So I'll use 183. Right? You can use 182, 183, I don't care, but somewhere kind of in the middle there. Actually, you know, that's fine. 184 would actually be better, but that's fine. Now, when is the second year cash flow going to happen? We'll assume right in the middle of the second year. What's right in the middle of the second year? You might give me a date. The beginning of the second year is what? 3/1/23. The end of the second year is 3/1/24. So when's the middle of the second year? We maybe want to add 365 there. Does that make sense? Isn't that the middle of the second year? We do that minus that divided by 365. Isn't that a year and a half? Right? So does that make sense? So in the first year, you're going to add 183 to get right in the middle of the year. And in all future years, you're just going to add 365. All right. Now in this project, the project says don't go beyond 5 years. You have to decide how many years out you go. I have a lot of teams that go out 5 years because that's my example I'm giving you. But you need to stop and think about that. You cannot do solar panels and go out 5 years. There's no way it's going to work. You can't get your money back on solar panels in 5 years. Absolutely impossible. All right, so you've got to make that decision. The electronic vehicle, you got to decide how long you think that car is going to last. All right, so I'm going to do 5 years. Now you do have leap year. What do you do with leap year? I usually fix it for leap year so that the day of the month is the same. All right? So do adjust for leap year. Questions on that? Makes sense, okay? You're gonna do this exact same thing on the exam and on your homework problems as well, so. All right, so let's talk about the benefits. So to get the benefits, we have to build up to it. So you have a couple of options here. You could add a sheet. You could do it in the assumptions page. You could add a sheet which defines all the benefits, and then you take that entire number and you just throw it into this column. So this could just be one number, or you can use this part of the Excel to actually build that assumption. I'm going to do the latter. I'm going to build it here. So the first thing I got to do is look at transactions. So how many transactions will it be the first year? 80,000. Everybody see that? So in the first year, start off with 80,000 transactions. How many will we have in the second year? We're going to have that 80,000 times, open parentheses, 1 plus, how much is it growing? 4%. And you have to lock that in with the F4 function. So in the second year, we expect 80,000 times 1 plus 4%, or we expect 83,200. Everybody with me there? What can I do with the 83,200? Can I just copy it down? It works, right? As long as I locked it in. As long as you lock it in, $sign, it works. If you don't lock it in, Bill Gates gets kind of upset. It doesn't work so well. So you got to lock it in. So it's always that cell. So now we got a forecast of how many transactions they're going to do. Next thing we want to know is how many are converted. This is the base case. So how many were converted? Y'all remember? %, right? So lock that in, 70%. Now, the very last year, you notice that it's 65,512.07936. They're not going to convert that many, are they? But strongly recommend you do not round. All right, you can use a round function. It's a great function. You can even do -10 if you want to round it to the nearest 10. But the reason you don't want to round is we're going to do the break even. For the break even, if you round, Bill Gates may not be able to find an answer. Because you can't get it, break even is to get things right to zero. If you use it a round function, it may not be possible. So do not round. I strongly recommend that you don't round. All right, so that's how many converted. FTEs saved. What is an FTE? Y'all heard that term before? I got a lady, a job at UTSA. She was an intern, so gung-ho, so excited about the job. And then she was in tears, and her boss came and says, I can't believe she doesn't know anything. It's like, what do you mean? Well, she didn't even know what an FTE is. It's like, are you kidding me? They don't use FTE in college. That's it. You're using your jargon and you're expecting her to, I felt so sorry for that poor lady because she was expecting this person to come in and know all this jargon. So any guesses on what an FTE is? It's a full-time equivalent. Full-time equivalent means, you know what? We've got 2 employees, but they're all doing half-time. So one working 20 hours, the other's working 20 hours. How many FTEs is that? It's 1 person. I got 4 employees, 2 are working half-time, one's working full-time. How many FTEs is that? 2 are half-time, 1's full-time. 2 FTEs, right? So She might have 6 workers or whatever. This is a full-time employee can do 20,000. She might have 2 part-time employees that can do 20,000 a year. She doesn't care. She's pretty fluid. You know, I can have 5 workers, 4 workers, 3 workers. They share that. So what we want to do is if we save 56,000 transactions, how many FTEs will we save? We take 56,000 and we divide it by each can do 20,000, lock that in. So we'll save 2.8 FTEs. At the very end, now here's where I had my debates with the accountants. They're like, you can't save 2.8 people. You can save 2 people. You can save 3 people. And I say, no, that's not true because Carol has a lot of flex work people that work 30 hours, 20 hours, 25 hours. She can hire 2.8 people very, very easily. So I'm sticking with that. All right. Are there cases where that wouldn't work? Yeah, there are times where there are not part-time workers. They're all full-time. And in that case, how do you get that? Well, there's something in Excel called truncate, which just says, hey, if it's 2.8, make it 2. All right. But that doesn't apply in this particular case. All right. The next thing we have to do is their payroll and benefits. How much are we paying each worker? We're paying them $50,000 times 1 plus 15%. So we're going to pay them $57,500. Notice I put a dollar sign there because that's the first thing that's a dollar. Everything else was a thing. And then how much will I pay them next year? $57,500 times 1 plus my payroll inflation. There's my pay. So I have 2.8 workers I'm going to save. I'm paying them each $57,500. But I see where I got that. That's the 50,000 plus the 15% and extra pay. So how much is my payroll savings? 2.8 workers times 57,000. Yeah, I got it. All right. Everybody comfortable how I got that? That's how much we're going to save doing this project. Why does it grow? Because we're paying our workers more and we have more transactions. You can see why I had to have both of these columns. I got to know how many we converted because that's going to influence how many workers are saved. But we're also going to increase the pace. So we have to have it separated out. Otherwise, it's just not going to work. And you'll discover that with your project. There's sometimes, and I actually recommend use more columns than fewer. Try not to have a massive formula that has 40 things in it because it just makes it really hard to read the spreadsheet. You're better off just using more columns and make it really logical how you're working that out. So there's my benefits. And then we have our cost. We only have one cost in this project. And that's our IT, software development. And when does that happen? We say year 0. So there's our cost. That's $1. What color is cost? It's got to be red. And then we want our net cash flow. That's pretty simple. You just sum your savings, your benefits. All right, so all we got to do this next class is we'll set up the NPV, the IR. We actually got the hardest part done, so it's going to go pretty fast this next class. All right, that's it for today. All right, so you got the paper back there. Really, the average is really strong. So it's hard to do redos, but there's a few people that really bombed on 1 or 2 things. So what I'll do, if you got a good score, please don't resubmit. But if you have 1 or 2 things that really crushed you, I'll let you change just 2, no more than 2. All right, it's going to take our average much higher. I don't mind the average on the project being higher because usually the average on the exam is about 5 points lower. So I have to average the two out. And I put the comments out there. I have no idea what they say because my words, I was typing fast. I did check all the spelling errors. And so, you know, some of them are pretty obvious. And then when I was checking the spelling errors, I read around and go, my word, that sentence doesn't make any sense. So it's a good chance what I type makes no sense because I was typing in Excel. So if you're not sure, call me. You want to know before the exam, and I think the exam's Thursday, if not on Tuesday, I can't remember. But if it's Thursday, you've got plenty of time. So what will the exam look like? Well, let's pretend like I didn't actually do a mock one, but let me kind of show you. Let's say, you know, obviously it's not going to be Walmart, but what you'll get is I want you to do it on your laptops. So if anyone's not going to use their laptop, you need to let me know, because if you're not on a laptop, I got to print out in color, which is a really difficult thing to do for this large of class. So how many people are definitely going to use their laptops on the exam? Who's not going to? Right, so essentially 100% out. So what I'll do is I'm going to send you this exam on Blackboard and you'll load it, and then you'll start typing. It's open, but you can't talk to other students. So if I get two papers with the same words, you know, you're going to submit it on Blackboard. So plagiarism, that's 2 Fs to 2 students. So you're not sharing with each other, all right? You can open your own doc. I don't want you opening notes, all right? Just your own project, all right? If you want to open the Walmart document, you can do that as well, but just your project in Walmart, but not the class notes, all right? Everybody understands that? But you will be very, very bad shape if you're relying on your company and the Walmart, because time is of the essence. So you can't be looking stuff up. You should study for this as if it's closed book. So you should only reference yours when you just can't remember something. All right. Otherwise, go through it as if it's completely closed book, because once the time's up, the time is up. So, right. So that's part of the stress of this exam is you've got to do it in the time. That was my kind of compromise when we went online. I don't like open book exams, but what I do is when it's open book, time becomes an essence. So you harm yourself when not studying it for closed book, and that really stressed out some students. But yeah, you gotta move fast. So watch your time. The CFA exam, if you take that, or the CPA exam, those are timed. You gotta watch your time. So, you know, be real careful on the time. Watch it. If you're still answering networking capital requirement and it's 340, you're probably in a lot of trouble. Okay, so you need to move along and type. But you get the types, which means you'll probably be a lot faster than if you write.
Are we like relabeling the graphs or like?
No, you're gonna get the graphs without the titles, but you don't need to change the titles of the graph. Right, so it won't say this, right? Because someone gives the answer away. But it's just gonna say chart 1's CFO growth or something like that. All right. So it's going to look like, remember the original Walmart before I changed the titles, or your original, it's going to look like that, all right? But they will be in order, so it's not like I'm going to put asset turnover first and gross margin second or something like that. They're going to be in the order you should write. It's all the liquidity stuff and the solvency. It may not be every single chart. So there's a couple of charts I might not put in there at all. Definitely the relative value is not going to be on the exam, so you don't have to worry about the relative value. There may be 1 or 2 others, like the CapEx, the CFO, or something like that, that I'll leave out. It'll probably be one company throughout, probably a company you know well, but not a company any of y'all did. I don't want anybody to say, hey, I'll just turn my paper in again. It's asking for my company. So it won't be that. But if you're a company you know, you don't have to know the company, though. You don't have to tell me what's going on with consumers or whatever. But if you're a company, you'll probably know. And be careful. Some of y'all, boy, I think sometimes you get so stressed out. Some of y'all had, I don't know if I can find it. Some of y'all had this in your paper. It appears to be related to the sale of certain subsidiaries outside the U.S. as discussed above. Does that make sense? That applies to only one company. And what company is that? Walmart, right? Don't put that on your exam. It has nothing to do with your company. I mean, it could be random 1 in a billion chance that I pick a company that did something last year with subsidiaries. But, all right, so some of y'all had in, I think you were so focused on getting the charts discussed that you saw that sentence and just, okay, whatever, and you just went on. So, you know, make make it make sense. I had one student has an interview and I said, hey, just show them your project one. But you do want to make sure if you have stuff like that in there, take it out because it can be really confusing. Especially you say as discussed above and you didn't discuss it above, that gets a little confusing. So, all right, so this essentially be it. I'll just hand this, you'll load it and you'll type it in Word and then you'll submit it on Blackboard. We'll try to start like at 2:25 and then you can probably go until 3:50. So you have 85 minutes essentially, but you have to stop at 85 minutes once the next class comes in. So, all right, any questions on the exam?
So does the project include the spreadsheet and Word doc, or just Word doc?
Okay, good question. I forgot to tell you. So what I will do is on the table, I will print that out so you'll have it. Because it's a real pain to have to jump to the bottom and look at that. So that you will have in black and white printed out, but all the charts, I don't want to print them out. So hopefully everybody here be on a computer, laptop. I'll double check that with the weekly email. So thanks, Anthony. That's a good question. All right. With me grading your paper, sometimes I had to go to the table and boy, I was like going down to the bottom, come back up to the top. So it's just kind of a hassle. Anything else? Y'all know what you're up to here? What about the credit ratings? On the credit ratings, I might actually put the credit definition somewhere in the paper there so you can go grab them or something. We'll see. That's not a big, so don't, I've had students ask, do I need to memorize all the credit rating definitions? No, you don't need to do that. I've used normal tables on a class for statistics and students ask me, do I have to memorize a normal table? It's like, no, so you don't need to memorize stuff like that.
Are we doing the whole analysis with just certain charts?
You're going to do 89, 90% of what you did for your project. There's no relative value analysis. I might take one or two charts out just because it's just too much for a timed exam. You might say there's not enough time, but I've given this an in-class exam by hand and students finish in 65, 70 minutes. There are a few that are just, so if you got some special exam issues, let me know before next Thursday, because after that, I can't make adjustments. Everybody's good? See what we're gonna do. So we'll see if y'all know this. There's a few papers, I almost never give 100s, but we did have 200s this time. And what I really loved about their paper wasn't that they understood just the analysis, but they actually went out and researched some other stuff, which I always love. That to me, I don't know what majors they are. I have to look them up. But all right, everybody's good. Let me show you something real quick. This will be on Zoom, so I want to take it out of Zoom. I got to log in real quick, just a second. Okay. So I get emails like this all the time. And so if, this is Montana. She was actually in this class a few years ago. She's working with Frost. I love to see. I wanted to share a great opportunity that you might be able to share with your classes. Frost Bank is currently hiring. So it looks like accounting majors. So if you're in accounting majors, juniors or seniors, are y'all juniors or seniors, or y'all sophomores? Juniors, maybe. So if you're junior, senior, business major, 20, 25 hours, GPA 3 or above. So if you're interested in that, especially if you did really well on the project, submit it and let me know you submit it, and I'll email her and tell her that you submitted it. All right. So, take advantage of professors as part of your network. So anybody interested in this, just email me and I'll forward it over to you. And if you do apply, make sure to let me know, because I will let her know that you're there so she can watch for it. All right, anything else? Everybody's good? Students always seem like really, really mad when I hand back grades. Even the ones that make good scores, they're like, oh, you're judging me. But yeah, it's just part of the college experience, right? You got to get the feedback. And I'm glad I got them done on time. Yesterday, I had 3 papers left. So I sit down, start grading them. I had just enough time. And then there's like a fire drill and we have to all leave the building. Like, give me a break, come on. So anyway, all right, y'all remember this? We got this all set up in last class. They have 80,000 transactions of these manual checks that are just a major pain. We think we can convert 70% of them. If we look at that, each person can do 20,000. If we look at that, we think we can save 2 to 3 people over time. We're going to pay those people $50,000 in salaries and an additional $7,500 in benefits. That's going to grow with inflation. So each person gets that. We have 2.8 people. We're going to save 161,000, growing to 228,000, partly because we're paying them more, partly because we expect these volumes to grow. So we're actually saving more people. All right. And then the software is going to be 560. So here's our net cash flow. So for your project, you're really working toward getting that net cash flow column done. Once you get there, the rest of the analysis becomes pretty simple. What you're going to notice is once you get year 5 done, you know, we stopped at 5 because that's what they told us to do. But if you need to go 10 years or 25 years, you should get your year 5 perfect, so you can just copy down. Everything just copies down really easily. I could go out, you know, 5,000 years on this if I wanted to. Who knows if we'll have checks in 50 years. But I could go, you know, all the logic would work. It just doesn't make sense from a technology standpoint. So now what we're going to do is we're going to calculate 3 things. We can calculate the net present value. We're going to calculate internal rate of return and a discounted payback. And I say we're going to calculate it. We're actually going to let Bill Gates do it. All right. 2 of them. The third one we're going to have to calculate. But before I do want to do that, I want to make sure we understand what net present value is. So we've already learned present value. So we got a cash flow of $161,000. So what's the present value of that number? So remember, present value equals the future value divided by 1 plus the rate raised to the n. Y'all remember that formula? That's the present value. So what is 161 worth in today's dollars? What is our I? So if you go back to our assumptions, our I is our cost of capital, 7%. And what is our time? Well, our time is our year. So we want essentially half a year. So let me set this up and see if y'all understand this formula. So I'll type it. You don't need to do this because you're not actually gonna, well, you might do this a little bit on the exam, but on your project. But so I'm gonna take the future value divided by 1 plus the rate. I'm gonna lock that in. Now this is one thing that's a little bit of a challenge that you're gonna see when you lock things in on the base case. You're gonna find it creates, Bill Gates does this really, really wrong. So you'll see later when we lock stuff in and then we create the best case and worst case, we're gonna have to edit the formula because it keeps referencing the wrong page, but we'll be okay for this right now. And then we're gonna raise that to the time. So this is a half year out. So we can save to the 0.5, but I wanna do it a little bit more precisely. Because it's not exactly a year out, so y'all see if y'all recognize what I'm doing here. Come on, Bill Gates, you really can do this better. Sometimes he really messes up. So, like there. So I'm going to take that date minus that date. That's going to be days. And I'm going to divide it by 365.25. Anybody, what is that telling me? Let's do it separately. That minus that divided by 365.25. What do you think I'm going to get when I hit enter? This is halfway through the year. It's 6 months away. If I count the number of days and divide by 365, I should get what? 0.5, shouldn't I? I'm trying to figure out how far into the future that is. That's about 0.5. All right. So So there's my present value there. I can copy that down. There's my present values, so the 228. Well, I have to make one adjustment, sorry. I got to lock this in because I always want to subtract the starting date, right? So if I lock that in, what happens the second year? I'm now taking today's date minus the original date. So that's going to be probably what, about 1.8, wouldn't you think? I mean, sorry, 1.5. I don't want to say with 1.8, but 1.5, that's about a year and a half. All right. We're not going to actually do this, but I just want you to know what a present value is. So the net present value of this should be the sum of the present values plus plus or minus, however you want to think about it, the cost of the project. All right, there's something wrong with the math, but we'll figure that out later. All right, let me see, equal X NPV yeah, that's the right answer. So I don't know, something I did wrong over here. I forgot to copy this down. Here we go. All right. So our present value is going to be a sum of those present values of the benefits minus the cost of the project. All right. So this is the present value. So $161,000 that we get in about a half a year now, it's worth $155 today. 175 we get in a year and a half, that's worth about 158. 191 in about 2.5 years, that's worth 162. This cash flow we get in about 4.5 years, that's worth 168. You take the sum of that and subtract out the 565, you get 245.18. All right, so what are you going to do? So we're going to let Bill Gates do all the work. We're going to use the XMPV function. Have y'all used that before? XMPV. I remember I was sitting in one of the investment society classes years ago, and they showed the XMPV. I was like, wait, what did you just do? I've never seen that before. So this is a new function they've added. And you know how Bill Gates likes to help you out? He gives you what you need to enter. So the first one's the rate, where our rate's going to be cost of capital, comma. The next thing is the values. So here's where you got to be careful when, all right, everybody, you'll notice this when you build your homework. You see how he said base case there. We don't want that, because when we copy this to make it the best case, we don't want it referencing the base case still. We want it on the same page. So anytime you're on the base case and you go back to change your formula, you don't want the word base case in there. So I'm going to take that out. The next one is the values. So our values is our net cash flows. And the last part is the dates. And when you do that, that's what you get. It's going to be slightly different than I just got, mainly because the dates, you know, it's slightly off by a few, I don't know, hours or something. So that's the actual formula we're going to use. So that's the net present value. The XMPV, what that does is it allows you, see again, he put the base case in there again. You do not want base case when you're on the base case page. So we'll fix that later, but you don't want the base case in there. You want to take that out. So the XMPV allows you to do that. There is an MPV function. There you put the 7% in and the cash flows, but you'll get a lower answer. Why do you get a lower answer? Anybody guess? Why is the MPV function giving me a lower? You notice what didn't I put in the MPV function that I put in the XMPV? The time. So if you don't give it time, what is Bill Gates assuming? He assumes all those cash flows. At first, when we said it was a half a year out, what does he assume? Exactly 1 year out. So he's 6 months further behind. Since you're further out, it makes your present value lower, and so you get a lower value. So we're not going to use the MPV function. We're actually going to use the XMPV function. Right? So he saved us that problem. The next thing we have to do is, do we accept this or not? So we're going to do an embedded, we're going to do an if function. If net present value, so when do you accept this project? What's the rule? Net present value needs to be what for you to accept it? Greater than 0. Greater than or equal to 0. As long as your net present value is greater than or equal to 0, and it's unlikely it's going to be 0, but as long as it's greater than or equal to 0, you can accept. Otherwise, what do? You reject. So that project is acceptable. Let's try the same thing with the IRR. So net present value, you take the present value, all the cash flows, subtract the original cost. If that's greater than 0, you accept. If it's less than 0, you reject. You're going to get some practice on this with the Excel applications. You're actually going to do this problem on your Excel application, but you'll also do some other problems to get some practice. All right. The internal rate of return, what we're doing there is we're asking what discount rate would we have to use such that the net present value is exactly 0? Now, one thing you can be sure, our discount rate is 7%. If the net present value is positive, we would have to raise our cost of capital to get the net present value down to 0. The question is, how high do you have to raise that? All right, and again, Bill Gates does all the work. We should be paying him some money. So you do X IRR. You do the values, and you do the dates, and you don't need to do the guess. And there's the internal rate of return. Now, what would happen if I copy this internal rate of return and paste it over my, what do you think the net present value is going to be? Based on the definition. It should be exactly what? Should be exactly 0. Let's see if that worked. Ah, there it is. So it worked. All right, y'all see the definition of IRR. What interest rate do you need to use to discount your cash flows so that your net present value is exactly 0? That's what the IRR is. Now, if you just do IRR equal IRR, you have the same issue we had before. You're going to get a, oh man, I'm not going to do that. You're going to get a lower IRR. I cheated. You'll get a lower IRR. Why? Because it's assuming all those cash flows happen at the end of the year, whereas the XIRR lets you be really precise. In fact, if I were you, I would never use the IRR MPV function ever again. I would stick with this X. Now, if you take the FACT exam, you finance majors, the FACT exam typically assumes cash flows happen at the end of the year. So you can get away with using the net present value function. And they do that partly because you may be stuck on a calculator, and it's really hard to do cash flows that are 6 months out if you're on a calculator. All right, so what's the accept here? So what do you think the rule is here? If the IRR is what? I'll tell you, it's greater than or equal to something, greater than or equal to something. 0 wouldn't work here because we got a 0 IRR, 0 WACC, our net present value would be negative. So any guesses greater than or equal to what? I got to go to the assumptions page if that helps you. What's on the assumptions page? Yeah, the cost of capital. You want your IRR to be greater than the cost of capital. If it is, you accept. It's not, you reject. So that one's acceptable. These are both acceptable. Got that? So since what they're saying is, hey, we need a 7% return. As long as we can make 7% or more, this is a good project. And then you calculate it and say, well, you're actually going to make a 24% return. You say, well, okay, well, this project makes a lot of sense. I can make 24, I only need 7. Let's go for it. Let's do this project. Right? Now the hard part. I don't know if I can fix these formulas or not. Let me see if I can get this base case out. I wish you wouldn't do that just because you switched pages. That one's okay. Ah. Somehow remember that. You just don't want the base case there, but if you have a problem, I'll fix it when you send me your spreadsheet. All right, the discounted payback, this one's really tough. But what we're gonna do here is we're gonna say, this project started off, we start off $565,000 in the red. But the first year, in today's dollars, the first year we got $155,000. We're still in the hole, right? We started with negative 565, we brought 155. The next year we have 158. So far we have about 314, still not enough. We're still behind. The next year we had another 162, that gets us up to 476, we're still behind. The next year we get we're up to 641. So now we've gone from a negative number to a positive number. What this kind of payback's asking, when in time did your net present value exactly hit 0? That's what it's looking for. When in time did our net present value exactly hit 0? All right. So what you have to add here is the cumulative net present value, the annual present value. We need those two things. So a cumulative net present value, we can use the X MPV function again. We know our rate's 7%. We'll lock that in, comma. We don't want base case. Stop doing that to me, Bill Gates. And we'll take the net present value of the first year, comma, with the first year's dates. Let's take those base cases out again. There's times I wish Bill Gates would just be sitting here and watching, don't you? That he could fix some of his software, because that's kind of irritating. All right. So at the end of the first year, our net present value is still negative $409,000. We're still in the hole. So what we're going to do is we're going to lock in row 5. And I'm going to copy this down. What's that the net present value of? The initial costs in the first 2 years. I'll copy the formula over so you can see it. The next year, what's our net present value now? It's the first 3 years plus initial costs. We're still in the negative. What's going to happen the next year? It goes positive. And then the last year, I better get 245,722. Because that's just the exact same formula. All right. And in this one, we just want to know what that annual net present value is. So here, all you do is you take each year minus the previous year, each year minus the previous year, and that just tells you their present values. If you want to, you know the present value of the 565,000 cost is 565,000 because we do that today. So if you want to, you can bring that over. All right, so here's where it gets tricky. So we have to have we can either do an embedded if, or I learned something new in Excel this week. I'm really excited. Y'all should be attending these investment study classes. I'm an old man and I'm learning new stuff there. Y'all would be like learning a whole lot more. especially if you're not an Excel user, but I'm even learning stuff. So we're not going to use an embedded if, we're going to actually use the conjunction function. But let's think about it. What we're trying to figure out, how many years, how much time does it take for this present value to go to exactly 0? So one thing we know is if the prior is positive, so if the prior number is positive, so if this number is positive, I'm in year 5, I've already successful, right? So if the prior year ending cumulative is a positive number, we don't need anything in there. So we're going to say, in that case, this year need 0. We don't need anything from this year. If the prior is negative and the current is negative, we need 100%. We're using up everything. We need that entire year because we're still negative. So what's the one we don't have yet? Prior is negative and current is positive. That's when we know we've hit this kind of payback. And so what do we do there? We take this year's present value divided by minus prior year cumulative. That's what we're going to have. That's how much of the year we're going to use. You're going to have to actually see it in practice for this to work, but that's what we're after. We want to do this in a formula so that we don't have to do it manually. So let's try a formula here. So we'll say if, well, I'm going to do it embedded first because it just makes it easier. So we know if the prior is positive, how much of the year we need? The prior is a positive number. You've already gone positive. How much do you need? Don't need any of it. Okay. If, so this is what we call embedded if statement. So what the if function does, and if you don't know if functions, you better learn them because they're really powerful. We use them a lot. So the if function says, if this is true, then do this. Otherwise, do this. So here what we're saying is, if the prior number is positive, give me a 0. Otherwise, and this is an embedded if because we're going to use an if function again, if the prior is, well, we know it's less than 0. So if the current is less than 0, here, then what do we need? How much of the year will we use then? They're both negative. We know, how do we know the prior is negative? Because the if function says if it's positive. So this says if this is positive and they give me 0, otherwise, what does otherwise mean? That must have been negative. So I already know that's negative. So all we want to know is if this is negative. If that's negative, how much of the year do we need? 100%. Otherwise, what do we do? We take, I'm sorry, I did it backwards. Oh, Bill Gates. Oh, my word. Okay, I'll have to redo that. I did this backwards, sorry. If the prior is negative, you take the prior's negative and divide it by the current year's present value. So sorry about that. All right, so well, let's give you some more practice. So if the prior is greater than 0, we need 0. Otherwise, if the current is less than 0, we need 100%. Otherwise, we're going to take the prior balance divided by the current present value, and that's going to tell us how much we need. Let me see if it works first, because it's hard to get this right the first time. Does that look like it could be right? Looks pretty good, doesn't it? All right, so let's copy that over. Powerful stuff. Why do we want to use if functions? Because you don't have to do this manually, right? You want, if you change the numbers, like for the best case, you want that formula already set up, so you don't have to go in and do recalculations. All right, so we come to this first one and say, hey, is the prior negative? Yeah, it's negative. Or is the prior positive? No, it's not positive. All right, so is the current negative? Yeah, it is. So I need 100% of this year. All right, so that worked. Same thing here. The prior is negative, the current's negative, give me 100%. Prior is negative, current's positive. And then we come here and say, okay, wait a minute. Is the prior positive? No, it's not. Is the current positive? Yes, it is. So I can't do that. I got to do this. So I'll say at the end of the prior year, we still had $88,000 deficit. $88,000 deficit. How much of this year's 165 am I going to use up so I get to the 88,000 to zero? Well, I started with the deficit at 88,000. This year gives me 165, so I'll take 88 over 165, and it went through about 53% of the year before I went to a zero net present value. And then the last one's pretty simple, is the prior year is positive, so we don't need any of that here, all right? So this project has a 3.53 discounted payback. So what we do here, we do equals sum. And we just add up those. That gives us our discounted paybacks. So on here, the accept reject is we have a payback standard. And I think if I can remember the problem right, I think they said 4 years. So they said, we want our projects to pay back in 4 years. If they don't pay back in 4 years, they're not acceptable. So how do we calculate this one? So you do equal if that is less than or equal to what? For our 4, comma, accept, otherwise reject. And I did something wrong, but oh, I hit the right button. So this project's looking pretty good, doesn't it? It's doing pretty well. Not a lot of no arguments for going against this project. It had a lot of intangible benefits. So it's going to pay back in 3.5 years. We're happy if it pays back in 4 because we're pretty confident with the assumptions and with the technology. So even if something comes along in 5 years that we no longer have checks, we still got our money back on this project in 3.5.
So with this current, how long does it take us the money?
Yeah. At what point have you exactly offset that 565, but not in future dollars, but in today's dollar, discounting it back. There are firms that do a payback without discounting the numbers. So they did what we just did, except they're looking at the non-discounted cash flows. When does that go positive? But we're using the actual discounted cash flow, so it's going to take us a little bit longer. Because not only have to get the project back, but we also have to put the time value money in there as well. All right. Now, this is the way you're going to find that I do my videos for the Excel application. Some students don't like it because they think it's wasting their time, but I like, while I'm doing the videos, to actually give you the formulas off to the side so you can see them. So if you don't like that, then just skip ahead. But I do that so that you can pause the video and look at the formula and see it much better. So I just like that. So if you don't like that, just kind of get used to it because I'm going to keep doing it. All right. So there's the formula for net present value. There's the accept reject formula, IRR, accept reject. So net present value, greater than 0, accept. Internal rate of return, greater than your cost of capital, accept. Discounted payback, less than your standard, you accept. Now, what about your projects? Here's what I want to do with your projects. I do not want you to have a payback standard. What I want you to do is use the payback and just talk about it. All right, so like, let's say you did solar panels. I don't need you to say, hey, our payback standard is 19 years. What I want you to do is calculate the discounted payback and just think about it. If you're doing an electronic car and your discounted payback's 23 years, I got to own this car for 23 years to make up for this cost. For a fact, the car is probably not going to last that long. You don't need to have a standard to say 5 years or 6 years. All right. So I don't need a payback. In this case, I gave you a payback standard because corporations usually do have one. But on your projects, on your team projects, I want you to calculate the payback standard, discounted payback, but without a standard. You don't need to establish a standard. and then just talk through what it implies. All right. Now I'm going to erase all these formulas if y'all are okay with that. Everybody's got what they need, hopefully. I can always do Control Z. I wish I could do Control Z in the rest of my life, but at least you can in Excel. So there's our base case. How long is it going to take us to build the best case? So when you do your projects, I'm going to meet with you on your Excel. I want to meet with you on your Excel when you have the base case built. I don't want you to have built the best case, and you'll see why, because once you have the base case built, building the best case is a piece of cake. It's really easy. All right, so we want to get this perfect, and I know this is perfect because I have this answer memorized. It was kind of funny at USAA. A good friend of mine, Amy, she was head of the tax department, and I was doing this class for USAA's accountants, and it was teaching them how to do net present values. So I created this problem, and Amy and I worked the problem separately. We got back together, we both had different answers, and we were both wrong. And so we had to go back and figure out our errors. And once we found the errors, we both finally came up with that answer. So, and Amy, I trust a lot, very, very smart lady, very good with Excel, so it gave me a good double check. You may find this on your projects. I'm pretty good at finding errors in your team. That's one reason you have to show me your project beforehand. The last thing you want to do is make your final presentation and there's some major error in there. That's just terrible. You don't want to do that. So we want to find that stuff in advance. So you want to build it. You want all the team members to review it, and then I'll review it, and I'll be asking you tough questions. I've had some projects that just had some such serious issues that the results were meaningless. Without fixing those issues, it just did not mean anything. All right, so how do we get the best case? Well, we just select everything, right? Control C, go to the base case, hit enter. We can go back to the overview. We can now hyperlink the best case. Here's our best case. What's the only thing in our assumptions that we change for the best case? Yeah, so we use 70% in the base case. We want to use, and that was B7. So what do we need to do here? Change it to C7. We have now finished our best case. And it took me probably 30 seconds because I was wasting a lot of time talking. But that's why you can see why you don't want to build your best case until you get your base case set. It's kind of a waste of time. So whatever you're adjusting for your best case, you just make that one adjustment. What do I count off for on your cases? If I see this, there should not be any keyed numbers here. Everything should reference back to the assumption page, right? Now, why would it be wrong for me to type 0.9 here? Anybody think of a reason why that would be a terrible thing to do? And what if my boss calls and says, you know, that 0.9, I really think you should use 0.85. If I did it like this, what do I have to do? First, I got to go figure out where that 0.9 was, and then I got to change that, and I got to do that over and over again. If my boss calls me and says, change this to 0.85, all I got to do is change it in that one spot, and it feeds everything else. So it's a really important part of Excel. When you build Excel, you want one page with all your assumptions and nothing else has keyed numbers. So if I see keyed numbers on your base case and best case, I'm going to definitely count off a lot of points for that, but we'll find it before we get to the grading part. The only key number you should have, really, I don't know if there are, you know, the plus 183, plus 365, but that's not an assumption. That's just the way we're setting up the spreadsheet. But there really should not be any, you shouldn't have 80,000 keyed there. All right, you want to make it so that if your boss says, hey, I don't like that, change it. You change it in one spot and the whole spreadsheet updates automatically. Very, very, very important. There's our best case, net present value. IR looks really, really good. You can see it went from a negative net present value to a positive one after 2.77 years. We're right at 0. Piece of cake, right? Pretty simple How would we do the worst case? So you can copy the base case if you want to, Control C, enter. Go back to the overview. Let's link it. What do we need to change? Change C to what? D. We now have our worst case. It's so easy. This one, the only reject is on the discounted payback. It's not bad if that's the only one because it's our worst case. But we did have one reject. All right, any questions up to there? Y'all see how this works pretty well, huh, Dutch?
So, would this be the same project?
You can use this for your project. So what's the only adjustment you might need to make? Well, these columns might be all different. You might have more columns on the cost. But once you get to this net cash flow, everything else is exactly the same. Net present value is off of this column here. So what you can do is, you edit these columns here as you need them. You may have to add and subtract some, but always keep the net cash flow exactly where it is, and then everything else feeds. The other thing you might have to do is add some years. But other than that, yeah, this format works pretty well. You do have to do some thinking about how to set up your assumptions to make it easy to set up the other cases. That's the thing. Do you go across the page or down the page? That's kind of the frustration. All right, so let's try one last case here. Let's do the break even. So I'm going to take my worst case and copy it over to the break even. Go back to my overview, break even. Now on the break even, you'll have to do this. This is where every project is going to be a little different. It depends on how you set it up. On this project, what I want you to do is put the break even assumption on the page. So I'm going to say break even conversion rate. And I'm just going to give it a number just to guess. I'm going to say, let's say it's 60%. Okay. So what percentage did I convert? I'm going to go up and reference that cell. Now, was that my break even? What do we need net present value to be on the break even? Exactly 0. So is 60% my break even? It's something lower than that. All right. So how could Bill Gates help us figure this out? What have y'all used in Excel that might help us figure out the break even? Any guesses there? There's something under data that can help us. Y'all see it up there? So have y'all used this what if analysis? Goal seek, data tables. I'm not a big fan of data tables anymore. I was at one time, but I think you can do it yourself. But goal seek's what we want. All right. There is one other thing you should build. We won't use it in this class, but I do highly recommend it under the add-ins. Solver is an incredibly powerful tool. So I would, if I were you, I'd add Solver to your Excel because you can do a lot of things with Solver. But the what even if is goal seek. So with goal seek, we want to set this cell to what? To 0 by changing what? The break even. All right. And you got it. So what's our break even? It's 49%. What was our worst case? 50%. So that's why our worst case was so close to 0. Right. So our break even is 49%. It's less than our worst case. So it tells us, our worst case I think is 50. If it needs to be better in worst case of this project doesn't make as much sense. If our break even were 2%, we'd be really confident in this project. If our break even was 65%, we're getting a little nervous because it's much higher than our worst case, but it's just very below. I did this project, and when I finished doing the analysis, I called Terry. He was head of the head of the cash management department. So Terry, man, the analysis is overwhelming. This project makes enormous amount of sense. let's don't go through all the steps, just get it approved. I'll come to the meeting, let's get this approved. I wanted to get it done as fast as possible because it's a really important project. It made a lot of sense. And y'all remember what I said about the software costs? That's probably overstated. There's probably some costs in there that really aren't true incremental costs. So the project's probably even much better than this because I don't really trust that IT number. That's the highest it possibly is, and there's probably some costs that should come out of there. All right, so we got our break even. What's the one thing we're left with? We need a summary. All right. Let's put the summary in there. If you want to, you can copy the overview back in if you want to put that in there. Okay, so for the summary, again, this will change a little bit project by project. But what we want to do is say, hey, let's look at this project. Let's look at its net present value. Let's look at its internal rate of return. Let's look at its discounted payback. Let's look at it under our base case, best case, worst case, break even. All right, so our base case, present value, internal rate, return and payback. Our best case, our worst case. Now on break even, let's see. This is a really smart class. Let's see if y'all can. What's our net present value on the break even? 0. Are we going to put that in there? I actually do put that in there. Why? From a definitional standpoint. Now, if you want to, you might actually round it to 2 so you don't get that -0. All right. I always tell students when you're dealing with your boss, you don't want to give the boss something that they're going to ask about. It's going to waste a lot of time. That's not important. So why is that -0? And you're now spending 30 minutes talking about how there's an error in Excel and all this kind of stuff. So in those kind of cases, not you're hiding anything. It's just that you don't want to have a conversation that means nothing. Now, what is your internal rate of return going to be? The net present value is 0 at the break even. So the internal rate of return must be exactly what? Remember what we defined? It's the discount rate that gives you net present value exactly of 0. And our break even, our net present value was exactly 0. And what discount rate did we use in the break even? Not 0, but did we use that? So our internal rate of return has to be 7% for the break even because we're using the 7% and our net present value is 0. So I'm going to argue that the internal rate of return is useless information on the break even. The only reason I'm putting the net present value there as 0 is for definitional purposes. So they can see how I'm defining that. Here's one thing students miss all the time on their projects, and I will count off for this. It is true that payback on this is going to be exactly what? Exactly 5 years. Well, it's exactly 5 years. Why? Because the net present value went to 0 and we only went out 5 years. Okay. So we don't need that. That's useless information as well. But here's the big mistake students make is some students on the worst case, let me just even show you an example here. Let's say our worst case was 35%. If our worst case was 35%, our net present value is negative. Our internal rate of return is negative. But is our discounted payback 5 years? It's not, is it? You need more years. So if the net present value is negative, your payback that's going to be calculated is going to be however many years you went out, but that's not your payback. You would have to add more and more years until you actually get to zero. So be real careful. If your net present value is zero, below zero, do not show your discounted payback, or you have to go out and calculate. You'd have to add more years. So how would we do that in worst case? We would just keep adding years until our net present value is positive, and then we'll know our discounted payback. Because you notice here, what is it doing? Everything's 1, right? Because it's still negative. So that we go to a zero net present value at year 5? No, we're still negative. We need more years. All right, so that 35% would not work here. So you don't want to show the internal rate of return or the payback on the break even, and you also don't want to show it anytime you get a net present value that's negative. You might have a positive net present value on the base case and best case, but negative on the worst case. Don't show 5-year discounted payback on the worst case in that case, because it's a wrong number. All right, the last thing I like to do is conversion rate, because wouldn't that be pretty important to whoever's doing this analysis? What did you assume? Well, I assume we could convert 70% in the base case, 90%, and then to break even, you can just go get it, right? So now you got a page that shows you essentially everything you need. In fact, you'll probably put this in your presentation. What's the problem with this? Well, let's start with formatting. These are dollars, so I'm going to show dollars. I don't show pennies. Is your boss going to say, oh, it's 17 cents? Okay, well, let's do this price. I thought that was 13 cents. No, it's unimportant. This I'm going to show obviously as a percent, probably with 2 decimal places, but maybe not. It's up to you. Payback, I'm going to do that. Right, so I got everything I need. Then you're going to fancy it up. However you want to do it. You know, make it look professional. So what's your recommendation on this project? Probably going to do it. Makes a lot of sense. It's not too much. You've got your scenario analysis in here. You got your break even in there. What we're missing here is the intangible analysis, and that you would have as a Word document or something. Now, what I tell students on their presentation, I am perfectly fine with you doing your entire presentation from the Excel. You don't have to go out and build some fancy PowerPoint. So you can do your entire presentation. You'll just have to have one page where you do the intangibles. But you want to set it up that, you know, I don't really want you wasting time on fancy PowerPoints. You really want to get to the analysis, and that's even true on the job. I think we waste too much time trying to become desktop publishers where we really just need to get the decision made. So I think that's pretty professional looking and definitely gives you what you need. All right, questions up to there? So there's my overview, everything links back and forth. You know, if you want to put other links in there, you certainly can. On your assumptions, make sure you're really clear where you got your assumptions from. Document that, and then if you need extra sheets to help bring that in. If you're going to do it in Excel, you can bring in pictures. You can certainly link the websites that just, you know, bring out what you want to bring. As far as, you know, the most important part of this project, beyond a doubt, is the assumptions page. That's where you want to spend most of your time as far as the project time. That's where you want to spend most of your time. And it's also where you want to spend most of your time in the presentation. What you don't want to do, I had a graduate student do this last semester. He goes, yeah, we had 80,000 transactions the first time, and then we assumed 70% were converted. The next year we had 83,200 and 70%, you know, Your boss doesn't need you to explain how you set up your Excel, right? They're going to assume you did all that correctly. So the purpose of your presentation is not to explain Excel to your boss. Do you think your boss wants to hear all of that? Go in detail how I calculated each cell. You don't need to do that. But I had students doing that, going every single cell and explaining every single cell. I was like, no, don't do that for me. That's just too much. All right. And go back to the notes unless you have questions. So you're going to actually be doing this exact project. I have an entire YouTube that shows you how to do it. And the nice thing is once you finish this particular Excel application, you'll have something you can actually use for your project. And you know, and fancying it up, you know, use better colors than I did. Whatever your favorite colors are. I should have used UTSA colors, you know, I guess. I'm just never really sure what our colors are. What are our official colors? So orange, blue, and black. Is that true, or is there something else in there? So is any white in there? Anybody know our official? Anybody got a UTSA shirt on? All right, so what do we want to do in the class notes? What I want to do is walk you through the textbooky stuff, because you need to know that, because capital budgeting is a big part of the interviewing process and also a big part of your first job. And then we got to talk some special issues, and there are some really serious problematic special issues that make net present value and internal return, rate of return problematic. But the first thing I want to do is talk about the process itself. So the process itself, I remember one day, I'll just tell you my history with USAA because I thought it was kind of comical. But this guy came over to my desk from the investment company. Says, Ron, I got this project. If I can get you to sign off on it, I got it made, because they knew I was just, and I had this reputation for, you know, being just a hard nose. You know, if they could get it through me, they could get it done. So he comes to me and shows me those Excel. Everything looks really, really good. It's all set up correctly. And I go, okay, that looks good. I can't remember the guy's name, but every file he sent to me was titled Ron Dude 1, Ron Dude 2, Ron Dude 3. Kind of a strange guy. But so I'm looking at it and said, I only have one problem, and that's your assumption for volumes. Your monthly volumes are higher than your current annual volumes. Why do you think you're suddenly going to increase your volumes of more than 12-fold? And his answer was, well, that's the assumption I needed to get a positive net present value. So, okay, well, I'm not signing off on your project, so good luck. And I said, why would you assume that? He says, well, they told me we had to get this project approved, so I needed a number that got it approved. So, yeah, that's not analysis. That's going through the motions, and I don't go through the motions. So I said, I'm not signing off on that. There's no way. They approved it, and they did that. Guess what they did a few years later? They outsourced that because it was not making them, they were losing money on it. They should have not done that. When I saw him do that, I called up my friend. She was working in a PNC company. She was their SFO. She was my first boss at USAA. I said, I got to get involved in cost benefit analysis at USAA, because that's just terrible. We can't be making decisions like that. So she let me do that. The CFO let me do that. So we came up with the process, and then I started getting to the base with the accountants. So they fired me from that, which was fine because I had nothing to do with my job. So I was doing part-time stuff I wasn't getting paid for. But to me, this is really critical stuff. You've got to be making decisions for the right reasons. If your boss tells you, get this project approved, you need to change bosses. Your boss should be saying, see if this makes sense. And if it makes sense, let's get it done. But if your boss is telling you, I need this project done, it's in my objectives. If I don't get it done, I don't get my bonus. That's not analysis anymore. That's politics. I would just say, I refuse to do that. You get fired and go find a better boss. And that's the way our process was there for a while. The accountants agreed with me on that part of it. I'm going to show you where they strongly disagreed with me, and that's when they fired me from a job I wasn't getting paid for. Those are good jobs to get fired from. So the first thing you got to do is find those projects to assess. Once you find those projects, you're going to do the evaluation, which is what we just did. You get your assumptions, you do the net present value, all that kind of stuff. You're then going to do sensitivity analysis. Not everybody does sensitivity analysis, but I'm always like, let's do sensitivity analysis. Let's figure out if we're wrong. I had one project, it was a marketing database project, for the name of it. extremely expensive, like 50 million bucks. And it had a positive net present value. But the question was, did it have any value at all? Its worst case scenario was we lost 50 million bucks because it may not have accomplished anything. They weren't really sure. So if you didn't do that sensitivity analysis, say, hey, we're going to spend 50 million bucks, we're going to get that $50 million back plus extra. I think management will want to know there's a good chance this thing doesn't work at all. We just wasted 15 million bucks. I think that's a pretty important thing to do. So sensitivity analysis, then you got to make the decision. And then you have to implement. And that's when you figure out your assumptions were wrong. Right? I made a cost benefit analysis to buy a Prius Prime. I bought it in December of 2019, assuming I would drive 10,000 miles a year. And then 2020 came, and guess how many miles I drove a year? Drove 1,000 miles. That's a pretty big assumption miss, right? It's obvious I wasn't getting my money back. This year I'm doing really well. I'm saving over 100 bucks a month now. The gas price is so high. But the first 2 years of this thing, I was barely saving any money at all because we weren't driving. So that's when you discover you have some errors. And then the other thing most firms don't do, but is after the project's done, go back and see, did the assumptions come out? So we'll talk about this. You have to set up the post-project review at the early part of the project. So if someone says, hey, if we do this project, our error rate drops 10%. The obvious question to ask is, well, what's your current error rate? So, oh, we don't know. It's too high. I say, well, before we're going to do this project, you're going to figure out your error rate so that when we execute the project, we can actually see if your error rate drops 10%. You need to be hard-nosed like that. Don't tell me employee satisfaction is going to go up if you have no measure of it. So before we do your project, let's go do a survey of employees and see where they are so that when we finish the project, we can go see if we improved it. You think about the post-project review before, because you may need to go do some stuff before. So what we're going to do is walk through this. I'm going to give you some of my lessons learned in that 9-month period where I was in charge of USA's CBA until they fired me. And then we're going to talk to special cases. All right. So we'll stop. I'll give you an extra 4 minutes so you can go study for the exam. If you have questions on anything, call me. I'll be on the bike probably in the afternoons because we have this beautiful weather out here. If you have questions on anything, give me a call.